SIP versus mutual funds. Which is better and which is safer? Especially, what's the difference? Let's find out in this detailed video. Hi, welcome to holisticinvestment.in. We help individual investors like you to take the right financial decisions to help you achieve your goals faster and smarter. So, what is a mutual fund? Mutual fund is like an investment vehicle. Like mutual fund is a pooled investment pot where many investors like you and me contribute. This is then overseen by a professional fund manager who invests it in a variety of assets like stocks, bonds, or a mix of both. The idea here is to spread the risk, diversification, and potentially achieve better returns than you could on your own. So, what makes mutual funds attractive? Number one, professional management. You don't need to be a stock market whiz. The fund manager handles everything from the buying to the selling and taking the market trends to account everything else he manages on his own. Number two, diversification. Mutual funds doesn't put all your eggs into one basket. Instead, it holds a basket of assets, reducing the impact of any single stock's performance. Number three, there's a variety of choices available in a mutual fund, which is available for almost every investment goal, risk tolerance, and investment style you might have. You can either choose from equity funds or debt funds or even hybrid funds, a mix of both. Number four is the potential for growth. Historically, mutual funds have offered the potential for higher returns compared to traditional saving accounts. But mutual funds does come with some considerations like market fluctuations. Mutual funds are subjected to market ups and downs. While diversification helps, there's always a degree of risk involved. Second is the investment amount. Some mutual funds, especially those focused on high growth potential, may require a larger initial investment. So, what is an SIP? SIP is the brick by brick approach. SIP stands for Systematic Investment Plan. It's a method for investing in mutual funds, but instead of a lump sum, you invest a fixed amount at regular intervals. It can be monthly, quarterly, which will be automatically deducted from your bank account. It's like adding those bricks to your financial house one by one. Here's why SIPs are so popular. Number one, suitable for all. SIP allows you to start small, with some platforms offering minimum investments as low as 500 rupees. This makes them perfect for young investors or those with limited funds. Number two is the discipline and consistency. SIP helps you cultivate a habit of regular saving and investing. Just set it up and the automatic deductions ensure you stay on track instead of splurging. Number three, rupee cost averaging. This is a powerful benefit of SIP. By investing fixed amounts at regular intervals, you purchase more units when the market is low and fewer units when it's high. This helps average out the cost per unit over time. But SIP do also have some limitation to consider. Number one, time horizon. SIP are best suited for long-term goals. The power of rupee cost averaging and compounding truly shines over long term. Number two is a moderate returns, which is potentially only, but still, SIP investments are typically spread out. So the potential returns might be slightly lower compared to a well timed lump sum investment. But remember, market timing is notoriously difficult. So, mutual funds versus SIP, which is better? Mutual funds are professionally managed investment schemes operated by asset management companies, AMCs. They aim to grow investors' money by pooling funds to invest in stocks, bonds, gold, and other securities. Essentially, mutual fund schemes offer investors a convenient way to access diversified portfolios managed by expert fund managers. But how do they compare to SIPs in terms of investment strategy? On the other hand, SIPs represent a versatile investment technique that allows individuals to invest a fixed sum of money at predetermined intervals automatically. Interestingly, SIPs can be applied across various investment avenues, including mutual funds, public provident funds, fixed deposits, and even gold purchases. So you can just take a pass and look at the features described by comparing SIP and mutual funds to better understand the concept. After looking at the features, we need to ask ourselves, why is SIP often recommended, especially when investing in mutual funds? So SIPs in mutual funds, how they work? So, with SIPs, investors commit to investing a fixed amount regularly, which is automatically debited from their bank account. These investments are then processed by fund houses, and investors receive a mutual fund unit based on the prevailing net asset value NAV. But how does this accumulation of units over time benefits investors? When investors make subsequent SIP investment, they acquire additional units based on the current NAV. This gradual accumulation of units allow investors to benefit from rupee cost averaging, where they buy more units when prices are low and fewer units when prices are high. Can you imagine how this consistent investing strategy helps investors navigate market fluctuations? To illustrate, for an example, let's consider an investor who wants to invest 10,000 rupees every month in the Canara Blue Chip Fund, a large cap fund, on the first business day of each month. Through SIP, this investor would accumulate units over time, taking advantage of market fluctuations to potentially maximize returns. Can you visualize how this investment strategy can contribute to long term wealth creation? So, which is better, mutual fund or SIP? Neither. SIP is a way to invest in mutual funds. SIP allows you to invest a fixed amount regularly, whereas a mutual fund is an investment vehicle itself. For long term goals, combining SIPs with mutual funds is a powerful strategy. So, is SIP safer than a mutual fund? No. SIP themselves are not inherently safer than mutual funds. Both SIP and mutual funds are subjected to market fluctuations. The safety of your investment depends on factors like the type of mutual fund you choose, your investment goals, and your risk tolerance. SIP can be a safer approach to investing in mutual funds because of rupee cost averaging, but they don't guarantee safety. So, finally, what should we choose? SIP or mutual funds? While mutual funds offer access to professionally managed diversified portfolios, SIP provide a disciplined approach to investing a fixed sum of money at regular intervals. By understanding how SIP work, particularly in the context of mutual funds, investors can make informed decisions to achieve their financial goals. So, see which investment strategy resonates with you, mutual funds or SIP, or even perhaps a combination of both. Whichever investment strategy resonates with you, you can go ahead with that. If you want to read a detailed review of this, you can find the blog post in our website. You can find the website link in a description. If you like more such financially beneficial videos, please like and subscribe to our YouTube channel. If you want proper guidance about SIP and mutual funds through a professional, you can speak with one of our professional financial planners through a one-on-one consultation with the link in a description. Thank you for watching.